Hello, everybody. Welcome to the Anomaly course, Core Content, Lesson 7. Here we're going to be going over SMT breaks for reversals. So the first step is you're going to create an SMT with a correlated market. And what will make it obvious that the assets are likely to break this SMT is if the SMT is in close proximity. As you can see, the failure swing high is in close proximity with the high that is being manipulated on the leading asset. Now the next step over here is the SMT actually is going to break. So that SMT is not going to hold because that proximity is very, very close. Once this asset breaks the SMT, that's essentially a trigger for the market to actually reverse. So as you can see, here is a depiction of that happening, right? As soon as that middle asset, it's typically going to be the middle asset, breaks that SMT, this is when that leading asset actually starts to reverse. In the ideal scenario is this triad sequence where the leading asset creates SMT with the middle and lagging asset. It doesn't hold. That middle asset breaks the SMT, but that lagging asset actually does hold that SMT. It doesn't matter if it's close proximity SMT or not on this leading asset. This is exactly ideally how we want to see this sequence play out. Now let's go over another ideal scenario for SMT break reversal. And this is a two-stage SMT in the form of a string switch. It's going to create a high, as you can see, a high on this asset, a high on this asset. And then that lagging asset actually goes ahead and breaks that SMT and simultaneously creates a new one, as you can see. This asset breaks the overall SMT but creates a new one with the high that was actually created with that first stage SMT. It kind of looks like a roof SMT, but it's in the form of a string switch, right? Because this asset over here was stronger, as you can see, because it took out the high, but now it's showing weakness as it could not take out this high. So it's showing weakness and creating that SMT divergence while also breaking that original SMT, which is a trigger for reversal. Now let's go ahead and go over some examples of every concept within asset generalization. First concepts we're going to be covering is SMT break for reversals. So as you can see, how do we know when SMT is likely to break? When a leading asset runs deep through a low or a high. So you can see this asset fails to manipulate its low. That means the middle asset, which is going to be over here, ES, right? If YM is the weakest, then ES will be the middle asset. That's when the middle asset is likely to run out that same low. And when it runs out that low, that is when price can reverse. And the most high probable sequence is when the strongest asset is actually not even taking out that low. It's actually creating SMT. So this is the triad sequence for SMT break reversal. Now let's go over another high probability sequence for SMT break reversal. This is in the form of a string switch. So you can see what is going to happen is that price is going to make an original SMT, right? And we know this is likely to break because of how close proximity this SMT is. This asset runs to the high, right? It's going to print a swing high. This asset, this lagging asset, is going to break that overall SMT and actually create a new SMT with the high that was created on the asset that was originally stronger that created that original SMT. So it looks like that roof SMT, and this is another way assets can reverse for SMT break. So now let's talk about when we expect the SMT to actually break within the middle asset. And that is when we create close proximity SMT. So you really see this when the leading asset here trades through a low. And you can see this when we drop down to lower time frame. You can see when we engage with this low here, we fail to manipulate it, we consolidated. When that happens and you're creating this close proximity SMT, so check out this close proximity SMT that we once created right here. At one point, this was close proximity SMT, as you guys can see. Right there. We know this is likely going to break if we do not reverse here, right? And I know there's a string choose PSP here, guys, but it happens at 1500, so very late in the day, so it just doesn't end up holding. But yeah, as you see, price clearly doesn't manipulate it, so that means that the trigger for this SMT to hold is going to be when ES, the middle asset, breaks, right? And we went over this in SMT break for reversal. So as soon as ES breaks the SMT, look what happens. We reverse while the middle asset is doing what? Holding it inside of a gap. So this is when we typically require that SMT break to happen. Now let's go ahead and cover advanced premium discount. Advanced premium discount is really simple. It's all about proximity in the space between SMT. So as you can see, the asset that creates a failure swing is essentially going to create its failure swing in premium of the range or in EQ, right? That's ideally where you want it to be created. And ideally, this asset is creating its failure swing inside of a gap, while that lagging asset is actually manipulating that range low, right? So really simple. This asset is in premium of the range or in discount, while this asset is manipulating the range low, creating that spaced out SMT. Really simple. So now let's view this within a triad where we have three correlated markets. This is ideally how we want it to look, is that strongest asset, that leading one, will be creating its SMT in premium. This asset, the middle asset, this middle asset over here is going to be creating its low in equilibrium, while that lagging asset is going to be manipulating that range low. Now, this is more of a negative condition. This asset is maybe in premium or equilibrium, and that middle asset makes a really deep run back into that range low, and this asset is actually making a deep manipulation through this low. So when we have that sequence, this is what we're going to wait for right here. We're going to wait for that middle asset to manipulate that range low and break SMT, just like we went over previously, and that will be the trigger for the market to reverse. Now let's go over an example where we can use the previous candle as our range high and low, and this is typically going to happen in the form of a PSP when they're expanding in opposite directions. So why does that naturally happen? Because this candle is opening up in premium of the previous candle's range, and this candle is opening up in discount of the previous candle's range. This asset's going to run out that low, creating a two-stage PSP. This asset does not. It stays up into premium / EQ of the previous candle's range. That naturally just creates that spaced out SMT that we're looking for. Now let's go ahead and go over advanced premium discount. This is essentially what we want to see, is spaced out SMT. It's where one asset takes a range high, manipulates it, while the lagging asset is either in discount or around EQ. We don't really want it to be in deep discount because that's creating the close proximity SMT. We want that SMT that is more so spaced out, and ideally the asset that's creating the failure swing or not taking out the high is actually in a fair value gap. So this is a great way we can mechanically define spaced out SMT by using the premium discount tool. And ideally the way we trade this is we have a strength switch at the point of reversal. Now you don't need a strength switch at the point of reversal if the asset taking the high is actually printing those V-shaped signatures and actually manipulating the high. But if it actually runs deep through a high or not really reversing, you absolutely need a strength switch. Now this is the most ideal scenario when looking at a triad, when viewing a premium discount range. So this is where the lagging asset takes out the range low. We're going to look at where the failure swings are being printed on the middle assets and the leading assets. So look at this leading asset. Where is it at? It is in high in premium, right? Very, very high in premium. While the middle asset is more in discounts or EQ area. This is perfect, right? This is the most ideal scenario when trading advanced premium discount. So now we're going to go over another way we use advanced premium discount, and that is going to be using the previous candle's high or low as a range high or low. So typically we're only going to do this, not always, it can be with any candle really. We're going to see it mostly happen when the previous candle is a PSP, because you have one candle opening near the low end of the previous candle's range. Well, this candle is opening near the high end of its previous candle's range. So naturally, you create that two-stage PSP, and you create that separated SMT, right? So if you drop down to lower time frame. So here we are on the hourly time frame. What do we see? This asset is running the previous candle's range. Well, this asset is not, creating that space that SMT want to see. And what is this asset? Creating its low end inside of a gap. So now let's go ahead and talk about failure swing SMT, where we actually don't have really an advanced premium discounts. So what we're going to wait for is the GXT universal sequence, which is really simple. After price creates that failure swing SMT, just wait for price to expand away and create a 15-minute or above gap. We're going to use this gap. We're going to wait for it to be confirmed with an SMT fill, some type of form of SMT, and then we can trust to trade away from these failure swings as price has showed us the willingness to trade away, creating that gap. That is the mechanical way to define displacements. And once that gap is confirmed, we can assume continuation away from this failure swing SMT. Now here we are viewing price within a triad again. This is we're going to have that failure swing SMT with that middle asset, which is what you're going to see in most cases actually, where this asset might be in premium, this asset's way in deep discount, creating that failure swing SMT, while that lagging asset is creating that deep manipulation. So what you're going to be waiting for is a strength switch between that leading asset and lagging asset. Once you have that, typically that means that this asset is not going to reach these lows because the lagging asset, the weakest one, is switching strength and actually reversing. So if this asset is reversing, then this asset is also going to reverse. And now here is the last way we can tell if price is likely to leave this failure swing SMT, and that is when the lagging asset over here is actually manipulating the range low, not making that deep run. If it's making that deep run through the low, then that means typically that middle asset is also going to break the SMT. But if the lagging asset is actually manipulating it, then of course, if the weakest asset is going to reverse here, then of course that middle asset will not reach this low, right? So it's really simple. If we're actually manipulating that range low with that lagging asset, the middle asset will not break this SMT. So now let's go ahead and talk about failure swing SMT. We can definitely trade away from failure swing SMT. It's going to happen like this a lot, right? We're not always going to have that space out SMT. So we can trade this, but we need extra confirmation. So let's go over some of the things we can require to do so. So the first thing is a Kraken correlation in the form of a strength switch at the point of reversal. So notice how this asset takes a low. This asset gets really close to this low. If we mark that out, check that out. Very, very close proximity. If you have a strength switch there, you can typically trust it. I like to wait for a clear V shape away on lower time frames, creating fair value gaps. So as you can see, clear V shape, creating gaps. I actually took this trade right here from this gap. I took it exactly right there. And that lower time frame expansion away is showing displacement away, so the intent to reverse. You're typically good there. Or you could wait for price to keep expanding away and create that gap in price on the 15-minute or above. So check this out here. We have a 15-minute or above gap, and you're essentially going to trade that continuation sequence, right? Where you're just waiting for price to really expand away, create those gaps in the higher time frame. You're going to use these gaps to then trade away into your draw liquidity, right? So if you play a price, as you can see, we get that SMT fill. This asset does not trade into the gap. This asset does. So now that is your extra confirmation to go ahead and target all these highs and trade away from this fair swing SMT. So you really have two options, right? Like I said, you either trade the reversal and wait for a strength switch, or let price expand away, create a couple of expansion candles. That's going to create that higher time gap, and that's what you're going to use to trade away from this fair swing SMT. So if this asset that is the weakest does not actually reject this low, right? It fails to manipulate it when you create SMT. Maybe consolidates, whatever, maybe trades right through it. That's when we expect ES to also break this SMT and be the trigger for the reversal potentially, right? Well, maybe YM holds at SMT. But if you have a strength switch between the weakest asset and the strongest assets, that is when we can trust that ES will not break this SMT, because that means that in Q, the weakest asset is actually reversing, and YM can also expand, of course, right? So you can actually see that here, except this asset manipulated. So it's not like we need the strength switch anyways, but we would only need that, like I said, if NQ failed to reverse here. But you can see that this asset, the low is Tuesday here, and the low over here is indeed Wednesday. So that is another scenario where we would have to require that strength switch. Now we're going to be covering asset synchronization, going over reversals, and the trigger for asset synchronization is going to be a concept that I created called strength switching. And this is how we typically confirm reversals. This is how we confirm SMT breaks. It is a two-stage SMT, but it is the most powerful type of two-stage SMT. And we are going to be covering every single type here. So firstly, let's go over the strength switch PSP. So it's just like any two-stage SMT where you have an SMT with the key level and you have a PSP, but it is a strength switch. So how is it a strength switch? Well, look here. This asset, by not taking out the low, right, the asset that is creating the failure swing SMT, is showing strength, right? These assets are showing weakness over here because it's taking out the low. But the confirmation, the two-stage confirmation, being a PSP, is now showing weakness by this closure here. You see that bearish close? Well, these assets are now showing sudden strength with this close, right? Showing weakness, showing strength by this bullish close, weakness, right? That is your strength switch. Now, this typically means that all assets are set to reverse, right? My personal favorite reversal confirmation is a strength switch PSP. It's the easiest, right? You have the candle closure, you have the strength switch, you have the key level SMT. It's just great. So this typically means that all assets are going to expand, typically, and reach the same draw liquidity. Not always, but it is typically the case, depending on the narrative. But yeah, this is my favorite type of reversal confirmation. Super simple. Now let's go over the next confirmation for strength switch reversals. This is where you have that key level SMT, and the next stage SMT, that strength switch is going to be with the swing point, right? The swing point that essentially created the SMT, right? Or the lowest point at reversal, right? So you can see this C2 is the lowest point, and then this asset over here takes out that C2 candle low. Well, these assets over here do not, right? And which assets do we want to trade, by the way? It's always going to be this asset here, right? Because it's closest to the draw liquidity. It's overall stronger. So we want to trade this asset here, okay? Now let's go over the last type of strength switch for reversal. And that is going to be with swing highs and lows, SMT. So essentially we're going to create an SMT divergence. We're going to print a low, right? So you can see there's no two-stage here at all. And that second stage SMT is simply going to be with that swing low that was created. As you can see, it looks like a roof, right? Like an inverted roof is kind of what it looks like for that strength switch. And what this really is, honestly, dude, is a higher time frame swing point low. It's literally the last slide, basically. But when you view it on the lower time frame, it looks like this. But really, you can visualize maybe that this is a new 4-hour open, for example. This is the previous 4-hour low, and it's simply swing SMT. But this swing low is a higher time frame. It's a higher time frame candles low. That's typically how it would look. But it's essentially the same thing as the last slide. But yeah, really simple. So here we are going to be covering what is a strength switch. So strength switch is a second stage SMT confirmation, but it is essentially where we get a short-term strength switch between correlated markets. And once we have that, that means that all assets are essentially ready to expand. So let's go over these strength switch variants. There is 3 variants. The first one here, which is my favorite, is a strength switch PSP. So as you can see, the asset that was originally stronger because it took out the high closes bearish, showing short-term weakness. And the asset that was originally weaker because it failed to take out the high shows short-term strength as it closes bullish. And this is a high probability reversal signature. And one thing you will see about strength switching at reversal is when all assets start to expand away from that, they typically all reach the same draw on liquidity. Now let's go over another example of a strength switch. So here, just going over a little bit of narrative, we have a 2-stage SMT fill here, where you can see this candle is a PSP, the high of the PSP is a gap, so you have that SMT fill, this asset's bearish. So there is our first stage SMT. And this strength switch variant is where you get swing SMT, confirming the overall larger time frame SMT. So as you can see, this asset shows strength because it is sweeping at the high. Then it shows short-term weakness as it fails to take out the swing high. And over here, you have that weakness, creating a failure swing, and that short-term strength, allowing both assets to expand towards draw liquidity. And as you can see, both assets are pretty much V-shaping way. So what does that mean? They're probably both going to reach that overall draw on liquidity. Now this is the last strength switch variant. It's very similar to the last one. Is where you have your overall SMT with your key level. Price prints as swing high. and then price strength switches with that swing high. So you can see the highest point here is 10 a.m. The highest point over here is 12 p.m. Now let's cover asset synchronization, SMT filtering. So now we're going to go ahead and cover asset synchronization, SMT filtering. And this is how we can tell which SMTs are typically going to hold in the market. So this is really simple, right? So when you have all assets reversing, right, they all hit a key level, they all have two-stage SMT, no strength switch, but the important thing we're seeing is that they're all expanding away, and this asset reaches draw on liquidity first. This is going to happen every single time the market reverses. Every single time the market reverses, the leading asset is going to hit the draw liquidity first and make an opposing SMT. So it's like, which SMT do you trust? Do you trust the ones at the lows or the highs? And this is what we're going to be going over. So now we're going to talk about how to anticipate SMTs to break. And there's a couple of things we're going to look at. So the first step is there a two-stage SMT at the point of reversal? Yes, that's what you want to see, right? You ideally want to see that two-stage SMT at the point of reversal. The next step is all assets expanding away, right? That expansion away is going to create the opposing SMT, right? And if we start to see these things, we can anticipate if it's going to break or not, right? Another thing we want to see is that expansion away on these lagging assets and middle assets here. Where is the failure swing being printed? If it is in close proximity to the high, in premium of the range, see what's in premium of the range here, right? This is a negative condition if you want to see the S&P hold, right? It's likely to break. So here I have this, showing this proximity here in blue because that's a good thing if you want to see continuation of this SMT to break. So now let's go over a negative condition, and it is quite the opposite of our last slide, right? We have the two-stage SMT at the point of reversal, but what do we not see? We do not see both assets here, that middle asset and that lagging asset, both expanding away with that leading asset. These assets are very lackluster in price action. It's just consolidating really. And what else can we see? The price didn't really expand and create that close proximity SMT. So this SMT that you're seeing here is likely to hold, and you're just not likely to see that asset synchronization for those lagging assets to catch up and break the SMT for continuation. Now here we're going to go over asset synchronization trigger for continuation, and that is going to be strength switching, right? So in this first example or variance, it happens with an SMT fill, where this asset shows momentarily weakness by trading into the gap, while that middle and lagging asset shows short-term strength by not tagging the gap, right? That is a trigger in confirmation to know that this SMT is going to break, and this is when we want to trade that lagging asset now to this exact high that this asset failed to manipulate. Now here is the second strength switch confirmation for continuation, and that is going to be a strength switch PSP. As you can see, they both hit the gap, so we don't really have a SMT for our strength switch, but we do have that candle closure as a PSP as our strength switch. As you can see, this asset, after engaging with that draw on liquidity, shows short-term weakness by closing bearish. Well, this asset shows short-term strength by closing bullish. And again, how do we even anticipate this is probably going to happen anyways? Because these assets are both having two-stage SMT. This asset, where is its failure swing SMT being printed? In premium. So we already know the asset synchronization is probably going to happen, but the strength switch confirms it. So now here is the last form of strength switching to confirm asset synchronization and continuation. And that is simply where we create an SMT divergence, we print a low, and you have a strength switch with that low, right? So as you can see, both assets print this low right here and here. This asset takes out the low, showing short-term weakness. Well, this asset shows short-term strength to confirm that strength switch and break that SMT. And this is with the asset that you want to trade and target that same high that the leading asset already traded into. So now let's go ahead and cover asset synchronization, continuation. So this is where ideally you're coming off of some type of reversal where both assets are expanding towards the draw on liquidity. There's some things you want to see, right? When the leading asset reaches that draw on liquidity. So as you can see, this leading asset reaches the draw on liquidity. And that is always going to create SMT, as you can see. Every single time the leading asset reverses, it will always reach the draw on liquidity first and create SMT. But we need to decipher which SMT is real and which SMT is fake. So here you can see, maybe you think this is strength shift PSP to go higher. Maybe you think that, right? But where is the SMT being created? Where's the failure swing asset creating that low? It is creating the low in deep, deep discounts, right? So when you see this happen, this is typically we're going to see that lagging asset actually catch up, right? And if it is going to catch up, it is going to create that strength switch. This is what confirms it for us, right? So there's a couple of variants of strength switching we can use. Firstly here with gaps. So as you can see, this previous high is a gap on the daily time frame created on both assets. So if this asset is going to catch up, we want it to show short-term weakness so it can catch up to the low that this asset already took out, right? That leading asset. So you're going to see here what happens. We have a strength switch in the form of an SMT fill, right? Perfect. So this asset just switches strength to catch up to the asset that already took this low, right? So doesn't just make sense? Since this asset's stronger, they want to create the same highs and lows, right? In a quarterly market, that's what price does. They create the same highs and lows. So if they're out of sync, this asset is going to switch weaker to catch up to that stronger asset. And that's what we see here. So now let's go over another example. So this is where you want to see price coming off of some sort of form of SMT divergence. So as you can see with this triad, we have a Kraken correlation. And what do we want to see, guys? All assets expand away. When all assets expand away, and then we create that SMT, right? We're going to look for one thing. Where is the failure swing assets, or the lagging assets, the middle asset? Where is that failure swing being printed in terms of premium discount? And as you can see, deep in premium, that is an SMT that is low probability. This SMT at the high is low probability, right? We can already decipher that this SMT is probably fake, and these lagging assets are going to catch up because all assets reversed at the lows, right? So this is where we can use SMT, ideally in the form of a strength switch like we have here, with a swing higher low. In this case, and for bullish, we want these lagging assets to show strength and not take out a low, while YM, the leading asset, takes out a low, showing short-term weakness, allowing these lagging assets to catch up and break the SMT. And what do you see? This asset over here, the middle asset, does not take out the low. The weakest asset does not take out the low, but the strongest asset does. That is a strength switch. That is a confirmation for asset synchronization, and we can actually trade these lagging assets to the same high. Now let's go over another example of asset synchronization. You're going to see the same thing happen, right? It always starts with a SMT, both assets expanding away. Once the leading asset reaches that low, you're going to look for where is the lagging asset putting its failure swing at, and clearly this is extremely deep in discount. So we know this little SMT here is highly likely to be a fake SMT, right? But these SMTs, what they do is they can be used for retracement. Almost every single retracement reversal in the market has an SMT. So we know which SMTs are likely retracements and reversals. We want to trade the reversals, right? So this SMT can be used to retrace price. And where is it going to retrace into? A key level. So as you can see, both assets hit this gap. And then we can use a form of Kraken correlation, ideally that creates a strength switch to confirm the next phase of price, which is expansion. And we want that expansion to go ahead and break the SMT, right? So in this case, the strength switch is in the form of a PSP. This asset closes bearish. This asset closes bullish. That's that short-term weakness that we're looking for this lagging asset to go ahead and catch up to that leading asset. Now we're going to be talking about how to anticipate when a SMT is going to break, right? And this side here really shows when the leading asset hits a draw on liquidity, for example. And if there's a reason to continue beyond that draw on liquidity, then that lagging asset is probably also going to engage with this high as well. So another way we can anticipate assets are going to break SMT is by the failure to manipulate. So here we're going to go over price signatures. Over here to the left, if that leading asset just straight up expands through a high, then obviously the SMT is not likely to hold. You might just get an expansion candle through the high, So the way to confirm that is a lower time frame CSD. As you can see, this candle engages with that relevant high. Once we retrace back into the range and close through, that is your breakout signature and your confirmation for the SMT to likely break. Now, the second price signature is when price engages with that high, creates SMT, but then consolidates. We know that consolidation is not a reversal signature. And when price consolidates after SMT, we know it's likely to break, and those lagging assets are probably going to catch up and break it as well. And the last signature, of course, is going to be retracement. We know that consolidation and retracements are both continuation signatures. So as you can see, there's no type of V shape or nothing like that, creating failure swings and lackluster price action. We know this SMT is not going to break. So we're essentially just waiting for that confirmation to, again, trade that expansion through this high. Ideally, you can trade those lagging assets to that same high. And one thing to importantly note is when you have these failure to manipulate signatures, you do not need a strength switch because we're expecting that leading asset to continue through it. So obviously, if it's going to continue through it, there's a reason for the lagging asset to continue higher. So that lagging asset can, of course, catch up to the same high that the leading asset failed to manipulate. So as you can see, both these assets engage with this gap here, but the candle that engaged with the gap also creates SMT with this high, which is a relevant swing, right? And once we break out of this high here and fail to manipulate it with that lower time frame, there's a reason for this asset to continue, which means that we don't really need a strength switch on this lagging asset to catch up to this high. Now, once that leading asset engaged with this high, it kind of restarts the process, right? Are we going to consolidate, retrace, or just displace through it? If we are, there's a reason to continue even further beyond this high, then again, we can expect this asset to reach this high, right? But if you don't get those signatures, then you would need a strength switch to catch up to this high. Now, here's another example of not needing a strength switch, where that leading asset, again, has a reason to continue. It consolidates, right? When we had that consolidation, that is our trigger to know that we don't not need that strength switch. It's going to continue, right? Because when you have SMT, you consolidate. That's not a reverse signature, right? So all you need essentially is an SMT, right? An SMT is the catalyst for every expansion of the market or every high probability expansion or reversal. So that's really all you're waiting for. Here is an example where that failure to manipulate signature is a retracement and then confirmed by a PSP. So now let's talk about signatures within asset synchronization. This is where we engage with either an internal high or the overall draw on liquidity, and we print a continuation signature. Price either expands right through it, showing failure to manipulate, consolidates, or retraces. Either way, those are all failure to manipulate signatures, and that is typically where you expect the lagging asset to catch up to either that internal high at the very least or the overall draw on liquidity. So in this case, we're going to be looking at an internal high. As you can see here on the daily chart, we engage with this range low and we can target the range high. And internal to that, we have an internal high. And as you can see, price just rips right through that internal high. So at this point, we can clearly see that price does not care about this SMT at all. Price is going to go through this internal level and expand to the overall draw on liquidity. And that's where we can expect the lagging asset to at least catch up to this internal high. Now, here's another example we've gone through throughout the course. We have an SMT at the lows. Price has expanded into the overall draw on liquidity. What does it do? It consolidates. And once it consolidates, it prints any type of continuation signature. This is where we do not need a strength switch necessarily. We just need a Kraken correlation to time the expansion and synchronization to the same high. In this case, we do have a strength switch. If you have a strength switch, of course, it's better. But we don't necessarily need it. As you can see, every asset consolidates. So when you print this SMT, that's not a reversal signature. It's a continuation signature. So as you can see, price will catch up. You can target that same high that the leading asset failed to manipulate. So here we are on the daily chart. And what we see is a Kraken correlation here and price expand into this internal high. And then it gives a retracement signature after creating SMT here, right? It's creating that really close proximity SMT. So we already know it's low probability or on the low probability side of things. So If we print a retracement signature into a daily gap and then print that SMT, right? No strength switch, like I said, you don't need it. Then we can expand through this SMT. This asset has a reason to continue, and then it's to get to this draw liquidity. Let's go ahead and drop down the 4-hour time frame and look at this retracement signature that confirms the retracement to expansion phase of price. So as you can see here on the 4-hour time frame, very, very clear retracement phase of price here. Very lackluster price action. Every time we take out a low, rejecting price, making these deep runs back in price. There's literally not one. There's like not one single fair value gap in this whole move lower. That is an indication of a retracement. So all we're really waiting for price to do is retrace into a key level, print SMT, and that should be the trigger for price to expand again through this SMT. The lagging asset will catch up and break the SMT, while this leading asset trades into a further objective. So here we are on the daily chart, and as you can see, we have a two-stage Kraken correlation. We have an SMT with this low. We have a two-stage PSP out of it, right? This candle is bullish. This one is bearish. You can see this. This is the day that created the SMT, but we reached up the low here, like so. And so we have some internal objectives on our way to this overall draw on liquidity, right? So we have this here. Let's go ahead and mark that out. And let's drop to the lower time frame and see if we print any continuation signatures when we engage with it. So here we are on the 4-hour time frame. And you see that the daily profile, if we zoom in, is a seek and destroy profile, right? We're opening high first and opening low with an SMT here, right? A seek and destroy profile is a form of consolidation. So this adds on to the probability that we will continue through this high to our overall objective. And this is actually a strength switch, not that we need it, but we do have it, and we can expect the next candle to expand into our overall draw liquidity while this lagging asset catches up to that same high that this asset failed to manipulate. So now we're going to cover relative strength with the indices triad. This is really the only triad we can really do this, and it's very important you understand this. So it's pretty simple. When NQ is the leading assets, in this example, we're bullish, right? When it's the leading assets, ES will almost always be the middle asset in any scenario. If the market's bearish on NQ or whatever, ES is always the middle asset, right? And YM will be the weakest. It'll always be the lagging asset if NQ is the leading asset, right? If YM is the weakest, then what does that mean for NQ? It's the strongest. ES is always in the middle. So that's something that's really, really important to understand. Now here we're going to go over intermarket relations for relative strength. This is something we can use to our advantage. It's not something we want to independently use. This is the way that I use it personally. I look for a market that is extremely strong in one direction, and that's how I gauge whether to pair it with my bias. This is something you're going to pair with your bias, really, not a solely independent thing. You're not going to put too much weight on it. It's like a confluence, right? So this is typically how markets move together. If indices is bullish, typically metals is also bullish, and oil is bearish, and the US dollar is bearish, right? If oil is bearish, metals is bullish, etc., right? So we can kind of use this to our advantage. If I see that oil is extremely bearish, right, and I'm not so sure the bias for metals, I'm going to lean bullish because oil is really bearish. So you get how I'm kind of using this. I'm not using intermarket SMT or anything like that. I'm just using it for strength and weakness for a given market. Now let's go ahead and cover relative strength. So here's an example of the indices triad. And this is something we can only view with the indices triad. When NQ is the strongest, YM is the weakest, ES is the middle. And when YM is the strongest, NQ is the weakest, and ES is still going to be in the middle. This is how it pretty much plays out all the time. You barely ever see ES as that leading asset. So first off, when you have a Kraken correlation like so, let's go ahead and mark that out. It is very important to trade the weakest asset because it is going to get to the draw on liquidity first, right? So let's draw this opposing low. You see, let's draw the same low over here and the middle assets. Okay, so as you can see, look how much sooner this asset gets to that low when compared to NQ and ES. NQ hasn't even reached it, right? You can see that when NQ is the strongest, as you see it took the high, it also just closed, or it hit this high a lot sooner rather than ES. You can see that, right? And then of course, if NQ is the strongest, YM is the weakest. And you can see that, right? You can see even throughout the whole entire day, this is the asset that pretty much filled in the entire gap, while this asset didn't even hit half of it really, right? It's also filling in this gap here, making deeper runs in price. So it's important to trade that weaker asset. This is gonna be a lot easier for you. You can see this asset here, like almost takes this high out. It's filling in the entire gap, like I said. Look at the retracement size. You know, it goes into a premium of this range where this asset over here doesn't even reach it to EQ, right? So you're gonna have a lot easier time to get to your draws liquidity trading the weaker assets. This is the asset that's going to be, sweeping highs at a lot of times, trading into gaps to form SMT to go lower, right? If there's SMT here, etc., you'll be trading this weaker asset. Now let's talk about intermarket relations. So this is something we can use as just a confluence, all right? And that is the relationship between the three markets that I personally trade, which is going to be indices, gold, and oil over here, right? So when indices is bullish, so will metals be most of the time. And oil will be bearish and vice versa, right? If oil is bullish, then typically indices and gold will be bearish, right? And it's something we can use more as a confluence. For example, like if I'm like, on the fence about a bias on a certain asset, right? If I see oil is like two-sided or something, not very clear, I'm not really sure. If I look at indices and it's just expanding like with aggression, then I'm going to assume I'm going to be bearish on oil because of the intermarket relation, right? If indices is bullish, then oil more times than not will be bearish. Not always. It's not always the case. It's not something we're going to use, S&P with or anything like that. It's simply a confluence. Now let's go over decoupling. So what is decoupling? This is essentially when within a triad of correlated markets, they are not correlated. They're going to be expanding in opposite directions. So specifically on the indices market, because of the relative strength that we understand, if NQ is expanding higher, YM is always expanding lower. You always want to avoid ES within a decoupled market because it's just going to be consolidating because it's the middle assets. So when markets are decoupling, this is essentially a form of a manipulation. It's one asset going to a key level while the other asset expands towards the draw liquidity, right? Think about it. One asset is making the fake move, expanding away from the draw liquidity to manipulate to create SMT, while the middle asset just waits for the manipulation essentially. And that leading asset is the real move towards the draw on liquidity. And this SMT is going to be the trigger for the markets to resync. So with markets expanding in opposite directions, that creates expansion candles that close in opposite directions, which is a PSP, right? So what is the trigger for markets to resync? It's essentially a manipulation, right? Which is going to manipulation of a range low. Let's assume the draw liquidity is higher. Then we know this move away from the draw liquidity into a key level, for example, is the fake move, right? So we know that SMT at the lows is going to resync the market, which is actually the creation of a two-stage PSP. So now let's go over what decoupling is. Decoupling is essentially when correlated markets expand in opposite directions. For indices specifically, or any asset in general, really any asset class, you're going to avoid the middle assets. You're going to wait for the market to resync. What is going to resync the markets is essentially manipulation, right? One asset will expand towards a key level, and that key level is going to be used to resync price. So as you can see, this asset here is expanding higher into a relevant high, creating SMT, right? While this asset expands away from that high, right? So the asset that is manipulating, its job is to decouple into a key level to create SMT to resync price. It's that simple, right? And as you can see, many times you will have a two-stage PSP resync price. So as price expand opposite directions, they close as opposite expansion candles. As you can see, this candle here is a bullish expansion candle, and this is a bearish expansion candle. This bullish expansion candle is trading into the high, as you can see. And it's only going to resync when the next candle supports expansion, essentially, right? And it's going to turn into a two-stage PSP, right? Obviously, this candle is going to take out this candle's high. So you have this two-stage PSP like that. Well, this asset creates a failure swing, and you're going to wait till this asset reverses to resync price. So now let's go over how we can actually anticipate the coupling. In this case, it's going to be reversal. So this is essentially when the market is already decoupled in terms of premium and discount. So notice how this asset before the decoupling is way in discount, right? Well, this asset's in premium above a high. Well, it's in deep premium because it's manipulating the high, right? Creating that space of SMT. So the market is already decoupled in terms of premium discount. And it's going to resync in the form of decoupling. They're going to expand towards each other, right, to actually become correlated again. And this is the creation of a two-stage SMT in the form of a strength switch PSP, right? When this kind of closes, it's going to create that bearish close. This asset closes bullish, right? That is the creation of that strength switch become correlated again, right? And we can use context clues to actually understand this going to happen, right? Because there's no SMT at the reversal. Notice how there's no SMT at the lows, right? So we already know that, this is unlikely to probably catch up, right? And break this SMT up here. And also in terms of advanced premium discount, this asset is an EQ, right? It's not creating that close proximity SMT. So it's probably not going to catch up, right? So we can actually begin to trade this. We can understand that, this decoupling move is likely to resync price. So now let's go over decoupling sequence for reversal. So this is going to happen when we decouple into an SMT, right? So notice how this asset expands higher, creating a cracking correlation. Well, this asset expands lower. Well, this asset is manipulating. And this is where we can actually trade this asset. You have to use context clues, right? Because we have the advanced premium discount. We have no SMT at the lows. So we know that the expansion higher is probably just to resync price, going to create the SMT. And we can actually trade this asset to these lows. And if you want to trade that lagging asset, we have to wait for this candle to close. Again, that's going to create a PSP. And obviously this PSP is an expansion candle, so it's likely to take out the high to create that two-stage PSP. And that'll resync the market, right? Now let's go ahead and cover decoupling anticipation. First, we're going to go over reversals. So this we have a decoupling in the form of a strength switch, where over here, if I have bar replay, the SMT will happen prior to the decoupling happening. So we already have this SMT in play, and then 930 rolls around, and the asset that manipulates is going to expand away from that manipulation, and the asset that's creating the failure swing is going to expand towards that SMT high. This usually happens in the form of advanced premium discount, right? They're just gravitating towards each other, expanding towards each other, and it is the creation of a strength switch, right? So a strength switch PSP is typically what is going to be created. You can actually trade this asset here if you don't want to. You simply just wait for the candle to close and you trade C3. It's simple as that. And remember, guys, we're going to be using profiling and narrative to decipher which SMT to trust. So as you can see, the profile or the low of the day is 1800 on this asset, which is not a relevant level. That is pretty much supporting our idea of this being a fake move on YM and this being the real move on NQ. So here is an example of price not manipulating prior to the decoupling happening. So here you can see we put in a high here, we put in a high over here, as you guys can see, have this high here. But what's important to note is on NQ here, we have an SMT fill. So you guys see that SMT fill? Technically, we have SMT fill. So this decoupling move right here, but even if you didn't have that, right, simply if you have a relevant level put in and your draw liquidity is lower, right, that relevant level, we want this decoupling to manipulate price, right? So you're automatically going to assume that this is going to cap off the decoupling. This is where you can trade this asset towards your draw on liquidity. As you see, price trades and expands there. Or you can simply wait and actually confirm this decoupling, which is the safer move, which is often what I do because decoupling markets can be somewhat tricky, but this is typically the protocol and the framework that we're going to follow in this course. And as you can see, that plays out very nicely. You're simply just waiting for the most recent level to be traded into. And you're going to assume that that is the area that the decoupling will cap off. Wait for the resync to get back on side with the higher time for move in line with that daily IRL to ERL universal model. Now let's go over decoupling anticipation for SMT break, which is going to be continuation over here. And this is when we come into the market and we have that perfect framework for an SMT break continuation where we have two stages at the lows. Unlike last example, we have that lagging asset also expanding away, creating its fair swing and premium, right? We know this SMT is probably already going to break. So when you see the market decouple back into the range on the leading assets and that middle and lagging asset starting to expand towards draw liquidity, this is a strength switch, right? To become correlated. We will understand this and know that this is the fake move and this is the real move. Now let's go over decoupling, market resync. And again, the decoupling is going to be in the form of a strength switch. And this is when we have that same sequence, right? Two stages into the highs. That leading asset had already reached the draw liquidity. And the move higher, the decoupling move higher, is simply a strength switch, right? This asset is going into a key level. While these assets expand away, right? Creating that decoupled move. Markets are expanding in opposite directions to become correlated. Now let's go ahead and cover how to anticipate decoupling continuation. That is very simple. You must be coming off of a two-stage SMT, and you must have a universal model, right? So here's the draw liquidity. We already know this is likely going to catch up because this left of screen asset rips right through that level there. And then you're seeing here that this asset's consolidating very high in premium. And you actually see the strength switching here. So you're already starting to see some form of decoupling, not really expanding. It's in this side of this wick. This asset's expanding lower, or maybe consolidating while this asset's more so expanding, right? Kind of gravitating toward each other. That strength switch, that's exactly what we want to see, is a strength switch in the form of decoupling to break the SMT. So when we drop down to lower time frame, on the 30-minute here, at 9:30, we see the stronger asset to the left that took out that draw liquidity a long time ago start to expand lower, while this asset on the right, which is very, very close to the draw on liquidity to break the SMT, is expanding higher. So we understand that this asset here is simply going to continue. This is the real move. This is the fake move in the form of a strength switch. So now let's go over decoupling, putting it all together, reversal versus continuation. So firstly, let's look at decoupling example at the reversal. So as you can see, price had created an SMT divergence, and then we see decoupling happen, right? So decoupling away from the key level is typically the real move. And for continuation, decoupling that happens away from the draw liquidity is the fake move, right? It's essentially just price expanding to a key level to again resync price to manipulate, right? To manipulate to then get back on side of the price. And that is simply how we decipher which asset is likely the fake move versus the real one. Now let's go over decoupling. We're going to put it all together and you're going to understand how to decipher which asset is manipulating. So here we are on the daily chart, and this is going to be going over reversal. So as you can see, we have an SMT here, an SMT here. So you have your key level SMT, and we have no opposing reversal at the highs. This is important. So why is this important? We have no opposing reversal at the highs, just failure swings. This is important because this is less likely for the lagging asset to actually catch up to this asset down here. You have an established reversal down here, but no established reversal up here, right? That is exactly what you want for a universal model. You want an established reversal at the point at the key level basically, and no established reversal as the draw on liquidity. That's exactly what we have here, man. So when we see price start to decouple, when price creates this SMT, That is the formation or the creation of a string switch, right? Where assets are gravitating toward each other to become correlated. So it's not the cleanest example of all time, but it's a good example of showing you guys how there's a reversal down here and no reversal up here. That's how you decipher it. So let's drop down to lower time frame so you can kind of see this. So here you can really see it at 9:30. That's when the coupling happens typically on indices. It's at 9:30. This asset over here to the right that was once weakest that took out that daily low to the left is expanding higher while NQ is expanding lower. But at this point, remember, you shouldn't be confused. What you're pretty much waiting for is a manipulation, and it doesn't really happen the cleanest, so you can't really do much about it. You have to wait till NQ engages with this low, and then you can look to trade that expansion higher. You get some decent move. You can trade that decently with this two-stage SMT here, but you have to be patient. You have to wait for this manipulation here. And as you can see, this asset was more so expanding throughout the day. This was consolidating, but at the end of the day, they create that decoupled uh, or that change in candle closures, which is a PSP. So they're pretty much moving opposite directions after we engage with the low. But you have to understand that YM is the asset that is trading towards the drawn liquidity, and that NQ is the asset that is going opposite of the drawn liquidity to manipulate to resync price. Now let's go over to coupling for continuation. This is extremely simple. You're going to have a universal model, SMT there. So what is our universal model here? Manipulation ranges really. So you have SMT at the lows. This is our drawn liquidity, which is higher on the daily chart. So it's really simple. Any move away from the drawn liquidity is viewed as the asset that's manipulating, right? So let's go to lower time frame and see this decoupling happening. So here we are on the 4-hour time frame. Again, when does decoupling happen? Typically within the 6 a.m. 4-hour candle at 9:30. That's exactly what happens here, right? This asset starts to expand lower back towards the reversal, while this asset expands towards the high, our universal model draw on liquidity. So we already know which asset is the fake move, right? And which asset is the real move. It's clearly YM going towards the draw is the real move. This asset is the faker, right? It's just retracing price, trading into key levels to resync price. So as you can see, when markets decouple, they create these expansion candles in opposite directions. We want this to be a two-stage PSP to resync price. So what are we going to require? A manipulation of this low to create that two-stage PSP to resync price. Let's see how that looks. And as you can see, this asset creates a C2 reversal to expansion candle. Well, this asset just continues towards the draw on liquidity.